Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Happy Bastille Day, everyone. I'm about 50 hours of watch time into the Tour de France, so bonjour and bienvenue. Stay tuned to this channel the rest of July. We've got Adam Chakuk coming on to talk through some private equity stuff, then working to get Surgify and Ben Eifert scheduled for a unique classroom-type format. Should be fun. On to this episode where Jay Soloff, he of the VIX Curve Doodles and KC Chiefs fandom, helped us out on short notice and came talking market making to education, covered calls to financial innovation. Send it. This episode is brought to you by RCM's Managed Futures Group. Go to rcmalts.com to learn more about how we help investors access unique hedge fund strategies. And now, back to the show. Okay, everyone, we're here with Jay Soloff. Welcome, Jay.
Hey, thanks, Jeff.
No worries. Did I get your last name correct?
Yes.
Soloff. And where in the world are you? Looks like you're in the world's best conference room, but everyone left for the day.
Yeah, sunny conference room. Actually, I'm in Gilbert, Arizona, which is a suburb of Phoenix.
Gilbert. Which way is that?
Southeast. So just due south of Mesa.
All right, on the way to Tucson?
On the way to Tucson, exactly.
My dad lives out in Tucson, so maybe
nice.
Next time I go out, we'll stop, have a beer.
Absolutely.
What do you golf out there?
I golf. So I went to grad school, got my MBA at Arizona State, and we golfed regularly, but then I hurt my lower back pretty soon after, and I can't swing a club anymore, which is fine because my swing was terrible anyway. So
how'd you hurt your back?
Years of doing the wrong thing, basically. I mean, weightlifting and football and stuff that I was never any good at. And I just probably didn't do things properly for a very long time, and it caught up with me.
I hear you. I have a bad back, which I attribute to those two same exact things, weightlifting and football. I'm like, I have to do these exercises for the rest of my life every night. They're like, pretty much. I'm like, come on, it's no good. And so what's the Kansas City affiliation? You're from there originally?
Yeah. I grew up in Kansas City. I've been in Arizona for 20 years, but up until just recently, I had been in Kansas City the longest portion of my life. So basically Kansas City, Chicago, and then Arizona.
But from your Twitter avatar, rabid Chiefs fan?
Yeah, Chiefs and Royals. I mean, that's
you don't meet many Royals fans, but okay.
Yeah, and for the longest time, my avatar was the Royals. But I was very disappointed in them this year. They were supposed to be competitive this year, and they're not. And so I'm like, you know what? I'm going to give the Chiefs a run for a while. But yeah, I mean, Royals. That's what I grew up watching, and then Chiefs. I mean, everybody in Kansas City is a Chiefs fan, of course.
And even, you ever seen those like NFL fan maps of the whole country, right? And like the whole center of the country used to be Denver, really, all the Dakotas and Montanas, but I bet a lot of that's turning Chiefs these days, probably.
Yeah. Well, when I was a kid, it was Elway. I mean,
exactly.
he would always beat the Chiefs.
So we were joking around on Twitter, like, what are your thoughts? Tyreek Hill's gone to Miami. They broke up the trio. Is that going to be good, bad, indifferent?
Yeah, my initial reaction was definitely negative. And then I saw he signed for like $30 million a year, and I'm like, there's so much the Chiefs could do with that. And they ended up having basically an ideal draft and a couple solid free agent signings. And it's one of those things where I feel like Mahomes elevates everyone on the team. So I think they'll be all right.
And if you had your choice, you're there in Kyler Murray territory. Mahomes or Kyler Murray?
I like Kyler Murray, but Mahomes, I mean, to me, he's the top quarterback versus anyone. I just don't think that it's particularly close. I mean, you have Josh Allen maybe, but I'm a huge Mahomes fan, obviously.
Yeah. I mean, what's not to like? But I feel like that trio should have gotten, what did they get? One championship? Right, of Mahomes, Kelsey, and Tyreek.
Yeah, one champion. I mean, they had a pretty bad game in the Super Bowl against Tampa, and then this year was the early exit, but I don't think they're done. That Reed is, Reed always keeps them competitive.
Yeah.
So
I was just pulling up my FanDuel account here. They're still plus 950 to win the Super Bowl.
they the favorites.
Yeah. Or they're the third. Bills, Bucks, Tampa, and then KC, then the Rams. So they're still got rid of him. They're still favored over the Rams. But anyway, yeah, I've never been to a game. How are the games? Awesome.
Yeah, and I pretty much only went for the playoff games when I lived there, and it was always a fantastic experience. I prefer generally to watch it on TV. I mean, weather can get pretty cruddy in Kansas City, and so I preferred to generally watch them at home. But we'd always go to the playoff games, and back like even when Joe Montana was there, and it's an amazing environment. Makes you forget about the cold and the rain or snow or whatever it happens to be doing.
Awesome. Well, I'm jealous being a lifelong Bears fan who's never had a quarterback of that caliber. So share the love, share the wealth. So you do some options education now, but before that, you got your start in the option space on the floor, CBOE floor.
Yeah, and actually, one more relevant connection to Kansas City. I actually started on the Kansas City Board of Trade, which most people don't even really know about. But
KC
it was a
wheat?
legit, wheat, exactly. Yeah, I mean, and you're a futures guy, so. But yeah, I mean, wheat was really big there. There was a couple other products, but wheat was really the reason it existed. And I didn't know. I got my econ degree from University of Illinois, and I really had no idea what I wanted to do. And my dad knew the CEO of the Kansas City Board of Trade, and he's like, "Hey, why don't you you're in economics. Why don't you go work for the Board of Trade?" So yeah, so I went and actually worked for the exchange, pit reporting and collecting data and that sort of thing. And then I'm like, I want to do this. And they're like, oh yeah, well, you need to go to Chicago because there are no jobs here. So
and I think KC was one of the first to go electronic.
They got purchased by, was it the CBOT or the CME? What? And then they moved.
It's all the same thing now, but yeah,
it's all the same thing. It hadn't merged yet, but it was about to. And yeah, that was like 2017 or something. And then it had already gone mostly electronic at that point anyways. But
I never actually realized there was an actual pit there. How big was the building?
It was pretty small. I mean, there were basically two kind of bigger, there was this really big pit for wheat. And then there was another bigger area. And when I was down there, it was half kind of the value line. So people don't realize the first actual derivatives on an index, on a stock index, actually started in Kansas City on the value line. But then soon after, S&P decided they wanted to get in that game, and they obviously had a much more popular product. But actually, that happened. The value line index on the Kansas City Board of Trade was actually the first one, and most people had no idea that that's actually your first tradable index future. And it stuck around for a while. There's also a natural gas product that didn't really trade. And so, I mean, the whole thing was picture two pits from the CBOT, room that, that's about the size of it.
And if we need to get one of my ag guys on here, I can't remember exactly which wheat is which, right? But there's hard red winter wheat, I think that's
Kansas City. Yeah.
That's the Kansas City version. All right. And the soft winter is Minneapolis.
Yeah. Soft winter is Chicago. Well, there's soft or spring. Spring is,
Spring is Minneapolis.
Yeah.
Right.
And then,
but guys, come after us on Twitter. We're butchering this, but
we are. But Kansas is the number one, the biggest provider in the world of the hard red winter wheat. So that's why it got developed there. So,
awesome.
So
then on to Chicago, into the CBOE pit. What did you do? So you were just working for the exchange. You weren't trading.
Right.
And then you get to Chicago and you get thrown in the fire.
Yeah. I wanted to trade and I just kind of, sat, did what you had to do back in the days, was just knock on doors and hand out resumes. And someone needed a clerk. It was Blackhawk Financial, which is just a small SPX options trading firm that happened to need a clerk. So then that was it. That I spent a year and a half or so clerking and setting prices for the index group. And then we kind of were full on our number of people we could send in the index. So they started sending new traders out to the single stocks, single stock options. So for me, it was Amazon and WorldCom were the big ones that I traded.
WorldCom. So what years? Yeah. What year is this? 01-ish?
This was 99, 2000, like around that.
So it's rocking and rolling.
Yeah, it was. Yeah. And then it died. Yeah. So it was like right before the, the .com bust and then the opening of electronic exchanges.
And were you had the sheets in your pocket there, or were you had a handheld?
Yeah, no, I didn't even have, so when I started, they actually had the exchange started handing out handhelds for entering trades. But when I was a clerk, that didn't, literally I was taking tickets from my traders and entering manually into the computer and printing out reports and running it back to him. So that
like to get his Greeks and whatnot of like, okay, let me plug you in and see where you're at.
Exactly. Like they had a little matrix of, there's their risk based on, prices and volatility. And I had this big, thing of sheets that I brought into the pit and my traders in SPX had, when I was a clerk, had these massive, like 2 foot long sheets that had all these prices. And then they go out there and like 30 minutes later, they'll be like, all right, you need to go redo the curve because everything's changed. Can you print out some new sheets and bring them back? I like run across the street to the office and print them and run them back. And
so I was a clerk in the bond futures pit. My broker, where I was my back's to him and I'm staring at the options pit, bond options. So they were arbiting their orders to delta hedge and whatnot to me. But I tell people all the time, like the amount of paper on these trading floors would blow your mind. Like you can't even fathom, right? At the end of the day, there's 2 inches of paper on the ground. But those option guys always, and for those of you listening, not on YouTube, right? I'm putting this huge sleeve of paper in my pocket and they'd have all the strikes, all the shocks each way, vol moves, price moves to see where their models thought the options should be priced given those moves.
Computers didn't have the handheld computers, if they existed, did not have the computing power to be able to do that sort of thing back then.
Right now, you pull up your Thinkorswim or
you can literally do it on your phone now, right? Yeah. So all the art, so you had all the arbing and all that. I had to learn that too. It was a lost art, right? But
we'll do it here for the YouTube. Palm towards you is buying 1, 2, 3, 4, 5. Turn your hand sideways 6, 7, 8, 9. On your head 10, 11, 12, 14. And then palm away is selling. Selling 5.
And then hundreds and thousands
on the chin, thousands on the arm.
But I actually almost went. I was supposed to go in the bond options pit. Actually, that was, and then at the last minute they decided to put me into equity. So actually, I was over there scouting that territory. Probably maybe around the time that you were down there. So.
Yeah, that would be. I'd love to do a little. Once we get a time machine, we'll grab some super good prop trader these days, right? Who's so screen based. Pluck him into the middle of the bond options pit in circa like 98, right? And like he'd think he was in a different alien universe, right? You had to learn a new language with your hands. You had to write everything on paper. You had to keep track of your positions in your head on cards.
And you had to do the math in your head. That's what they used to tell clerks. I mean, we used to sit there and have mock trading where they would, give spreads and you'd have to do, and things traded in sixteenths. And so I had to memorize all the decimals for sixteenths and be able to quickly do that math in my head. That's what I was good at. I'm not even sure if I would make it as a market maker today. I don't have a computer science degree. I don't have a PhD in math. Like I was really good at quick math. I could think on my feet, but that's not really a skill that you need anymore.
Yeah. So, the human computer. And so I was thinking about this. If you worked as a market maker, right? I'm always talking to guys who were at prop firms or were market makers, but it's always past tense. There's very rarely are there guys, unless they now own the prop firms, that are like, oh, I've been at a prop firm 20 years, or I've been at a market maker 20 years. Why do you think that is?
Yeah, I mean, if it's anything like the experience I had, it's really it's an amazing experience, but it's very draining, right? Like I had a lot of sleepless nights. I had a lot of mornings where I woke up like sweating over what Amazon was going to be doing in the after hours, and do I need to get to the floor at 6 a.m. and trade before the market opens? So, I mean, it's it's a little different now with screen trading, and also you have algorithms that can handle a lot of your action. But back then it was a physical thing. You were standing all day. Sometimes you'd be done after a busy day and you'd be exhausted. You wouldn't want to do anything. But I think it's just a stressful thing. And a lot of people who started on the floor may have moved off floor. So either you burn out and you go a different direction. You start on the floor, then go off the floor. And if you're managed to be around that long, you probably made enough money where you could probably do whatever you want, like switch careers or just
get like, why it's almost NFL-ish, right? Like, why am I going in there and getting my head bashed in every day? If I've made enough money, just get out of the game.
But small market making firms no longer exist. There's like a handful of market makers, and it's a very, different, I dealt with, basically 2 stocks with a maximum of 5. Now you can trade 1,000, right? Because of the software and technology. So it's a different game. Like, you could probably be a market maker long-term, although it's still, from the people I've talked to, it's still plenty stressful. I mean, there's still, it's just not maybe the sort of thing that you're mentally you can handle over the course of 10 or 20 years.
Did you ever go up against some of our other podcasts on here, Jem Carson or Noel Smith or?
Jim was down there when I was, and knows some of the same people that I know, but I never met him. I would have been I think he might have gone on when I was a trader, but I was already away from the SPX at that point. Some of the, there's definitely some other Twitter presences that were, Dennis Davitt. He was actually in the Amazon pit after I was, and he was in the SPX there. He was in this kind of the same place, and maybe I knew of him in passing. And I mean, there's a few people definitely that like I probably interacted with, but I didn't really know till later on in life.
And what had you transition from moving off the floor? So did you still trade your own account when you left the floor?
No, it was actually kind of a weird and unexpected path. Like volume dried up. So WorldCom started going downhill. They were starting to get in trouble. They didn't disappear till 2004, but they already started to have trouble around like 99, 2000. So volume started drying up there. Amazon, just before the .com bust started, went from whatever was high of 110 back down to like 10. And there was no options volume. And I wasn't really sure. And this was my first pit, and there was no volume, and I was like, super stressed out. I'm like, how am I going to make money? And the specialist in the pit, who was Eddie Boyle, who's now actually the CEO of Box, which is the exchange that also has a little floor there in Chicago. He was like, hey, some guys were, when I was, wrapping up my position and like saying, I'm not really sure what I'm going to do. He's like, well, there's these guys from Switzerland with this really cool market making software, and that's the direction the markets are heading. Maybe you should talk to them. And they were talking to me about needing someone who understood American markets. And so I contacted them, and they hired me. They're like, oh yeah, we could use someone who really understands that you've been there and done that. So I went to Wall Street for like about a year, and then back to Chicago with these guys, Actant, helping, like basically on the floor of Bear, JP Morgan, stuff, like working with these traders on how we can improve the software. So that was cool because I got to see the off floor stuff, and I wasn't trading. I was more of like a software consultant. And yeah. So
what happened to that group? They didn't make it?
Yeah, they did. They're still around. I had some kind of weird desire to get my MBA after 5 years from undergrad. I honestly, to this day, I don't really know. I think maybe I was on the business side and the software area, and I'm like, you know what, maybe I want to manage a company. I don't know. I don't remember what I was thinking, but also I was tired of winters, and I applied to one place. I applied to Arizona State. So I'm like, I want to go someplace that's warm, and and they had a pretty decent MBA program. So that
and now who's your coach? Bobby Hurley? Is he the basketball coach?
Yeah, that's right. He that's pretty relatively recent. I still don't really follow. I'd follow U of I, Illinois, where I went to undergrad, but I never really got into ASU sports. that much.
Herm Edwards might be their football coach. Changing gears a little bit. So I've been seeing a lot of vol twit and less so those pros, but more so kind of some tangential people being like, CBOE should have never created the VIX. The VIX should be at 45. Why is the VIX only up 10%? So a lot of these, like, might call them dumb comments for lack of a better word, but just weigh in if you can on, what's your take? Why isn't VIX at 45 with the markets down? Is it broken? Give us your thoughts.
And it's, and I hesitate to say, I think, there are some, certainly some very, some comments on the VIX where people clearly just don't understand the product. A lot of those, but on the other hand, like the VIX doesn't necessarily, the VIX can do weird things. And so sometimes sometimes people are right to ask questions.
Yeah.
But a lot of times I think it shows a lack of understanding. It's first of all, I think it was, I'm a big fan of financial innovation. Now that I work mostly with retail, I like that there's access to stuff that you can trade, VIX ETPs, VIX ETFs, things like that. The fact that stuff exists, the fact that volatility is almost its own asset class. I think these were all great innovations. I think you should be able to trade just about anything as long as you can understand it. So I've always been on that kind of side of the fence.
Except Bitcoin ETFs, if you're the SEC. But
yeah,
we'll
Bitcoin
save that
ETF,
for another pod. Yeah.
Yeah. And I'm not, I'm not a fan of cryptocurrency per se, but yeah, you should be able to trade it if it's something that's, if it's something that's out there and liquid, then you should be able to trade it. That's kind of my belief. Ben Eifert, I tell him we should have a variant swap ETF, and but that part I'm kidding about. Those aren't, but yeah. So the question is, there's a lot of things that go into it, right? There's the supply demand aspect of it, of just the SPX options themselves. But you also have to take into account like what's going on with realized volatility. So for instance, if you look over the last 10 days, I think we're at like 16. And so, and although it's not a direct comparison of realized volatility and the VIX, it's a ballpark, right? If the VIX is at 26 or whatever, and the last 10 days we've been trading at 16, I'd say something's gonna give there, right? Eventually. Now, if the VIX is forward looking, and so if you're looking at something like if you like back in 2020, you might look at the presidential election you knew was coming down the pipeline. So no matter how slow the market was, VIX was staying at a certain level because options had to price in that uncertainty of the election, right? But during the summer months, you head into the summer months, and realized volatility slows down. Even if the market starts, moving a lot, it doesn't necessarily mean that people are really going to buy into it. Another thing, and this has been talked about probably ad nauseum, but there's a lot of front month option selling as part of systematic programs, right? A lot of put writing, a lot of covered call action that happens even at the at the pension level. So that part is the demand. The demand is there to sell options, so that's going to also kind of depress prices in the front month. So there's these other components that go in. There's institutional flows, there's forward looking, there's what the market is actually doing. And all these things kind of have to be taken into account when you're looking at this stuff.
Right. Which is sort of the gripe, I think, for a lot of people of like, you gave us this one indicator to understand this stuff. And then all the explanations are like, well, it's more than just one indicator. There's a ton of nuance involved in there. So it's kind of like, should we even be looking at that if there's so much nuance that it's hard to even understand it as a single indicator? So it's like, it works most of the time, some of the time.
Right. It's sometimes it does what you expect. Other times, you're right. Like it can be very nuanced. So it's, if it was easy to understand, just like stock picking, right? Stock picking, you may guess what you think a stock should do. It doesn't mean it's going to do it. If any of that stuff was easy, then there would be then no one would make any money there. which is hard to do anyways. Right? So,
Yeah. And how did you guys use VIX back in the day as a market maker? Were you using it all, or was it more single name?
no, we did actually look at it, although it wasn't like, I don't even know if I think it was publicly disseminated. It definitely wasn't tradable. But we were aware of it. We would look at it. It might have still been VXO or whatever they call it now. It might have been the one that was based on the OEX. I can't remember when they changed that over. So it used to, the SP 100 used to be how they calculated.
Yeah.
That used to be the bigger product, and then they switched it over to S&P 500, and then they went from and then they also changed the methodology to the variant swap methodology. So it was a little bit different back then. I don't remember the exact timeline. They changed the product, and then they changed the calculation from basically an at the money straddle to a variance swap. And so that all happened like around the time I was down there, but it was something we kept an eye on for sure.
And dig into that a little bit. You were delving into Ben Eifert territory here, but the at the money swap or at the money straddle versus the variance swap. Dig into that a little if you could.
Yeah, sure. So there's certainly nothing wrong with looking at an at the money straddle. That gives you your, general idea of what your implied volatility is for any product, right? But there are other factors involved with a straddle, particularly if you move away from it, it no longer really reflects, then you're dealing with basically options. So you move away from the straddle, and you're not dealing with an accurate picture of what volatility is doing anymore. Yeah. So I'm trying
to just give an example. If we're at 3,800 in the S&P, what's my at the money straddle look like?
I'm not, I actually haven't looked in a long time. I'm not sure what it's priced.
What am I buying and selling? I'm saying.
Yeah. So you're buying and selling. Like I said, I don't even know what the prices are anymore, but yeah, you're buying and selling this. So it's 3,800. You're buying and selling the 3,800 call and put, right? So you're buying one each of the call and the put. That's funny. Like I have no idea what the straddles trade at these days.
Last time I looked, it might've been like 21 or something. It seems light, but
those things, yeah, that sounds about right. But those things, it's a convex. When you're buying that straddle, it's a convex product. So as you move away from it, you have these other factors, gamma, and you have these things that are impacting it. And as you move away, it's just no longer necessarily an indicator of what actual volatility is doing. So the variance swap methodology uses like a strip of options. So it's a more so what goes on in the wings, so to speak, so the out of the money options on the call and put side, as those change, those can change. Sometimes you'll have the at the money not change that much, and the wings will change a lot. Like that could be reflected in the variance swap calculation, where if you just have the straddle, it may or may not be reflected in there. And there's nothing wrong with using a straddle. It's not really a pure measure of volatility, where the VIX based on a variance swap, and basically the way that any new volatility index for the most part, when they come out like spiked or whatever, which uses SPY, it's the variance swap calculation. Now, if you like VolQ, which is for NASDAQ, is a straddle. Like they wanted theirs to be that's Scott Nations. They wanted theirs to be the straddle. So I mean, there was a conscious decision though, right? That's the way they wanted to express there. So.
And to me, that's more how retail thinks about it, right? I think they think of it more, I think it would help them better understand if maybe there should be two products, right? Of like VolQ in the S&P, SPQ, and VIX, or VIXQ or something. We'll come up with the name, but whatever. I'm like, okay, I have these two measures. Here's basically the floating strike volatility number, and here's the fixed strike volatility number, right? That's kind of what we're saying of like, if I bought volatility at the beginning of the month with this straddle, did I make or lose money, right? Did it expand or contract from where I bought it? Versus the floating strike is where a lot of that nuance, I think, is that people have trouble understanding.
Yeah, and I'm sure that someone like Ben Eifert could explain it a lot more. I mean, this is stuff that he deals with on a regular basis. Like he could probably explain it, to where it goes into encyclopedia somewhere. But yeah, I mean, I think that's a good way of looking at it.
Well, we'll bring it back to him later. And so it kind of like, I don't know if I'm pulling that thread a little more of like, do you think we created a monster with the VIX, or you're thinking overall it's a good thing? Let people have the ability to trade it.
Yeah, no, I think it's a good thing. I think volatility, personally, I think volatility is easier to trade than stock direction, because it follows characteristics that are more predictable. Clustering, mean reversion, it's got some stuff that you can do. And so if you study it, I think there's more opportunity there, and used properly with proper risk management, I think it's a really good addition to a portfolio. And, and particularly now with, we're going into potentially an era of low expected returns from bonds, from stocks, and you need to get into alternatives to really to really juice up your portfolio. And that something like managed futures, or maybe some style premia, momentum, things like that. But then one of those is carry, and short volatility is essentially carry. So I mean so I'm specifically speaking to short volatility, I think something like that is extremely important. Again, maybe not for person just learning to trade, but as you start to get more sophisticated, and I know plenty of retail traders who are definitely sophisticated enough to do some basic short volatility strategies. I think that's something that should be a part of just about every portfolio when you're trying to hit certain yield numbers, right, or certain percentage return numbers. So
yeah, and then the worry is, of course, like a Feb 18 happens, and you get terminal break even trade, some would say. So you can collect that, and then boom, something happens and you lose all of the previous gains.
Right. Yeah, that's the counter. But I mean, something like covered calls is not really going to have that kind of risk, and will potentially smooth your returns along the way. So I don't disagree with you in the sense, like, I mean, I wouldn't necessarily just do a straight up put writing program, and set it and forget it. Like maybe you can if you're a pension fund and your view is very long term and you need to meet cash obligations and things like that. But I mean, something like covered calls, like it wouldn't really, Feb 18th would have been a blip. Or I'm sorry, Feb 18 would have been a blip.
Yeah, exactly. Well, they would have got called. No, yeah, wouldn't have even really mattered. And then, so you do a lot of these VIX curve doodles. I don't know if anyone's ever seen them. Go check out Jay's Twitter at JASOLOFF. Go through the timeline, you'll see some of these. Tell us a couple of your favorites doodles there on the curve.
Yeah, it was funny. I just there was I was looking at VIX Central, and like one of them looked like the Batmobile or something. So I just kind of drew that on there for fun, and I posted it, and it got like a ton of likes, right? I got all of a sudden it was being retweeted, and I'm like, why do people like this stuff? There's nothing but that was it, right? So I'm like, all right, I got to try this a few times. So I think I did. I think sort of the quintessential one is like a dinosaur, eating something, with teeth,
flame.
and yeah, and yeah. So then, Ben and Jim Carroll, and some of the other guys in the volatility space, whenever it's kind of a funky curve shape, they're like, hey, you should draw something here. And I started just keeping an eye on it whenever I saw something and it popped in my head. I'm like, hey, that looks like a flying saucer, or that looks like a snake or something. And I try not to take myself too seriously.
Here was this one of the recent ones, unladen VIX tortoise. Good one.
Yeah, there's been some Monty Python references floating around for a while. So,
but then how do you think about the curve and how it's looking now versus the past? It's had some weird shapes to it this year, right?
Yeah, I mean, but a lot of that, I mean, a lot of the stuff that I draw on is zoomed in, and if you zoom out, it's basically like a straight line. And but we're back to kind of standard contango. I think you're seeing the vol selling programs, in full swing again, with the reason why we're sloping up. You have that dip in December. It's funny because this time of year, there's always all the comments on Twitter about like what's going on in December. Are people like, is it the election? And it's like, no, it's just a day count convention. There are less trading days and in December, and it always makes this bump in the curve. It's like as people, it's good to see, I think, that people are actually looking at the term structure and stuff like that and saying, hey, what's Fix trying to say about the market, and actually thinking about it, even if it's not obvious. I like to see that, hey, what's this saying? What this is another point of analysis. I like to have as many, possible data points that could be relevant as out there. So, when people are asking questions, I think that's really good. But again, as new people get in, you see the same questions. What's going on in December? Is it broken? No. Just day count convention, right?
Right. And dive into that a little more. I don't know if people understand that. So it's all in the math of the calculation, but there's so many. December has fewer trading days because of the holiday.
Yeah, because of the holidays, and that's, it's literally the math part, like fewer trading days, lower number. It's not. It's a simple like mathematical property almost of the equation.
Right. If you what's the variance there? So if you moved 2% a day divided by X days, you have such and such variance. If you have it, the lower the denominator, the lower the total number.
Yeah.
Interesting. So, right. And then that's where retail could get screwed up. Like, oh, look at it. I found a little gem here. It's trading at a discount. Nope. It's trading mathematically where it should be trading.
Right. And it'll be priced in. And even though it's, we could say, well, maybe I sell November, buy December, blah, blah. No, that stuff is already priced in, right? So it doesn't mean it won't work, but if it works, it's going to work for a different reason.
Switching gears here. So a lot of your stuff's on options education. I ask anyone with even slight options knowledge of where do you stand on the whole gamma hedging. Dealer gamma hedging is the one force that rules all of the market galaxy. What's your stance on that?
So if we give it a scale out of 10 on importance, I'd probably give it a 5. And I know that's kind of a cop out, but sometimes it is important and sometimes it isn't, right? Because I think the reason that it's not is because there's always so much going on beneath the surface that we don't see. And you might see something that shows up in the listed markets that's related to something that's happening off the market OTC. And so you're maybe seeing part of a much more complex thing going on. And that probably happens quite a bit. On the other hand, it's important for, something like, JP Morgan hedge equity. This is another thing that you see on Twitter these days. Every quarter, you have this, whatever, $15 billion fund that does a put spread collar. Basically, they're selling calls and they're buying a put spread, and they roll that on, $15 billion of SPX options, and they're rolling that every quarter. Everyone knows it's coming, and it kind of changes the prices of the curve. That's where it's important, right? Like if you have a known, and there's not too many of those, most people don't want it to be known.
At the same time, that seemed like a bit of a nothing burger so far, right? Like everyone gets all hyped up for it, and then they basically synthetically roll their strike by doing different strikes. And
they caught on to the fact, right, that I'm sure that after a while of doing it and people changing the pricing because they knew it was coming, I think they've started to adjust, or maybe not do it all at once or do it synthetically or whatever. I'm sure that they don't appreciate people front running the trade. And maybe when it was small, it probably didn't matter. But then when it's publicized on Twitter and you can have millions of people potentially trading ahead of it. But, there are situations like that where I think, like in the ETF space, like, you have covered call ETFs, and some of them have gotten quite big, and you'll see, that in their prospectus that, a week before expiration, they start rolling the 3% out of the money call or whatever. So, I mean, there are things out there where, seeing that flow matters. And, certainly, we saw what happened during the meme stock the whole gamma squeeze stuff with GameStop and AMC and how the dealer hedging, mattered, but that mattered for a very short time and then they adjusted. Right. So, I mean, anything that happens there is pretty quickly, used for the market makers will find a way to use it to their advantage, basically.
It's the mantra of this pod so far that it's complicated, right? It works some of the time. And so coming back to options, what do you write mostly on this kind of retail stuff, like covered calls, selling puts, straddles, condors? What kind of is your go-to on the education side? What are you making sure people know about the option space?
Yeah, so I started out being, when I got into this industry, thinking like, hey, I know about sophisticated stuff. I used to be a floor trader. Let me share with you the sophisticated stuff because you're not going to get it elsewhere. And I thought that was pretty cool. But it turns out that it's just like there's only, and it's grown over time, but there's just not that many people that really want to get into the weeds of volatility and fancy trades and even stuff like iron condors. That's the very first so I have started out with just like newsletters, like recommending, trade ideas. And I did it with like iron condors and it was cool. And there was like 100 people very interested in it, but it's just like, that was like the limit. It never grew. There was, like 100 people interested in trading iron condors, right? Yeah. And then but ultimately what changed, I think over time, just my own knowledge of the industry and reading about it. And and if Ewan Sinclair, he's written he's written 3 books, 3 very popular books on option trading. And I've started doing webinars with him and I learned a lot, over the years. I've learned, a lot of what I know about options from Ewan in his books. And when there were people on Twitter basically saying, covered calls, that's, it's a garbage strategy. It's not, it's not what people make it out to be. And Ewan was there saying, no, it's actually really good, particularly for retail, because it's something that they can easily do. And it's something that takes advantage of the equity risk premium, basically owning stocks, and also the volatility risk premium, selling options and doing so in a relatively safe manner. And so listening to him, I'm like, I've kind of felt that way. And I was like skeptical because of all the comments I was reading on Twitter, but then I have like, this, my mentor basically saying, no, that's fine. Right? So I've really gotten into that. I think, the last couple of years have focused on covered calls or similar type stuff and how, retail can use it to improve themselves without taking on too much risk, improve their portfolio.
And so what would you say, right? The cons on covered calls are like, we'll just do less equity, right? It's basically just you're reducing your equity exposure.
Yeah, no, exactly. Yeah. If you're in a runaway bull market, you're going to underperform stocks. If you're in I'm not a big fan of using it on indexes because, or like, popular index products like SPX, because the premiums have been sold. So it's such a popular trade that it's just not worth it, right? You don't even need a runaway bull market. You just, any sort of bull market, and you probably would be doing better just holding it. But, I focusing on single stocks and, doing kind of a mix of single stocks with high premiums, but not a whole ton of volatility. Obviously that sounds like an oxymoron, high premiums, but not a ton of volatility. But there's a middle ground where you can find decent premiums without finding something that's, has a chance of going to zero, right? There's a middle ground there.
Yeah. That seems counterintuitive, right? Like, I feel like I want to sell calls on the super volatile stock.
You do to some extent, but only, only if you don't want to sell something that's going to go from, 50 to 100 in a month, and you don't want to, or something that's going to go from 50 to 25. But if you think it's going to go from 50 to 60, that's still relatively volatile. Let's say just in a month period, and there might be decent premiums on it, but you're also not going to, it's the sort of thing where, you can capture some upside without leaving too much on the table, but also not the sort of stock that's going to, have the bottom fall out because, they've sold one electric vehicle and they're worth $2 billion,
Yeah, right. We got a handful of those. So do you view it more as an income producing strategy, or like an equity replacement, or absolute return? Like what do you view the covered call strategy as? Of
I mean,
what bucket would I put it in?
Again, like you'll hear naysayers, but I do think it is an income type of strategy. I mean, it's in the sense that I focus on the premiums. Like, so, while I enjoy stock picking, it's not my specialty. Like whatever. I went to business school. Like, I know how to analyze companies, but that's not what I've specialized in. What I know about is volatility and option premiums. And so I really try to focus on that and find like these really, these premiums that I feel are overvalued. And then I look at the stock and say, okay, now is this company going to be, is their biggest revenue generator in Bitcoin, or is it on, tires, right? Yeah. And the one with tires is not going to zero. Like, they may have a rough period, but they're not going out of business, right?
I always view this a little weird, because in my brain, just what I've done over the years personally, right? I'm like, a stock gets to a certain point, I feel it's getting riskier, then I sell the calls. You're talking about more of just, you find a premium you don't like, you buy the stock, sell the call simultaneously. Mm-hmm. Right? So what are the differences there? If you're saying, as a strategy, as an income producer, find the premium, and the stock's basically to make it a delta neutral trade, essentially.
Yeah, the stock is your collateral, so you can collect the premium. I mean, there are times where I do think there's upside in the stock, and we'll sell 30 delta calls and try to capture some of that. But that's, generally I like you said, I like to look at it from the premium standpoint. I do think there is a place for doing what you're talking about, where you have this, stock, and it's, whatever, it's gone way up and the premiums are crazy. I mean, you could have done that with something like AMC, and it was like a $20 stock, and you could sell the $30 call for whatever, 10% premiums or whatever it was. That's a good trade. I mean, it's a good trade. That's worth the risk, but that's not really, the clients I deal with are generally either retired or close to retirement. They don't want to look at their portfolio every day. If they can make, if they can capture 3% a month in premium without risk of a stock going to zero, they can use that money, right? In their retirement. They can take that 3% and put it into something safer. They can use it to freaking pay electric bills or whatever it is. That's important to them, is having that steady cash flow. So, I mean, they don't want to be looking at their, they don't be looking like, AMC, isn't that a movie theater? Why is it moving, $10 a day?
Why is it more volatile than Bitcoin? And what about the other side? Do you do put rights as well?
I do. Just, puts, obviously, not obviously, if you're in the business, that puts tend to have more premium, just because people use them for hedging. So there's more demand, and the market tends to go down faster down than it goes up when it goes up. So you have more premium in puts. The difference is that, when you sell a put, it's not the same as doing an at the money cover call is the same as selling a put, right? The same P&L graph. But usually you sell a put in that case because the premiums are higher. But if you're doing an out of the money call and you have the chance for it to go up, then if you think something's got some upside, then you probably want to do the out of the money call, because you want to try to capture that upside. And like during the last several years, when the market was mostly going up, that was the better strategy. Now, in times like this, selling puts, mixed and not fully, because they're obviously, with the VIX has been 25, 30 plus, like there always is that possibility of a 5% down day or whatever. You don't want to go crazy with it, but clearly here the premiums are very high on the put side. So it makes a lot of sense to sell, targeted put selling. You can go pretty far out of the money and still get pretty good premium, or at least you could. Things have started to come back down to earth recently.
And then my worry again on all of that is, it's like at the terminal break even. Eventually that'll catch up. So you got to either
right. If you're just if you're just selling puts willy nilly, eventually you're going to have a big down move, and you'll probably give back all your gains. That's why targeting that stuff, and, or maybe having, doing single stock short puts and then having maybe an equity hedge, or this is where you're talking about having the VIX, having like a VIX or a UVIX, which is a 2x VIX ETF call in there to, to potentially hedge yourself. I mean, that there are ways to do it to where it's not, it's not the cliche pennies in front of the steamroller trade, right? Like you don't have to do it that way.
And what do you think of, you've listened to a few of our pods with some of these pros, right, that do this for a living and structure these things and are looking at it day in, day out? Like, I don't want you to talk against your book, but right, like at the end of the day, it's like better to hand it off to the pros, right? Like if you're retail and you're just playing around and you're learning, but if this is truly to like generate a return for retirement or whatnot, what are your thoughts on being retail versus investing with some of the pros?
Yeah, certainly, certainly using pros. I mean, particularly if you're, if you're looking to have a solid long-term portfolio and you want to make sure it's going to be there 30 years from now. Like what I do, I generally recommend, a small portion. This is for the people who want to trade actively, particularly, they have the time or they're very interested in the markets, and take a section of your portfolio that you don't have with the pros that you could trade for yourself. I mean, it's like if I want a, just for example, I want a proper tail hedge, and I've come across a ton of money and I have it invested and I want a proper tail hedge. Yeah, I'm going to go to Ben Eifert, right? But I think there's nothing wrong with having an allocation towards something like covered calls that you can do it yourself. I'm not going to do managed futures myself. That's for sure. I'm going to hire a professional for that.
Yeah. So, well, I look at it as like, oh, I'm going to invest some money in my buddy's restaurant, or I'm going to pick one of these Oklahoma MLPs and take a flyer, right? Like it's just kind of play fun money, not necessarily fun, but right. Money you can afford to lose. But in the option space, it's particularly interesting because but I don't think if I'm investing in my buddy's restaurant, if I'm buying MLPs, I'm not really out there to learn a lot. But I feel like a lot of the option investors have a dual mandate, right? Like I'm sure if I make some money, great, but I also want to really learn what's going on here in the option space. Do you tend to get that out of the people you talk to?
Yes. Most of my longtime clients and the ones that if I introduce a new product or have a webinar and they basically show up to all of them, they're there to learn, and certainly some of them are not they're doing everything themselves. Like they really enjoy that aspect of it. Or maybe they
keep showing up. You're not doing a great job of teaching.
It's my charming personality.
Exactly.
My comedic saying. I mean, you've seen my VIX doodles. I mean, they just. I try to cover a lot of time. I mean, I talk about. I have the degree in economics and the business school degree. So I mean, I try to talk about stuff like central bank policy and alternative investing and diversify your portfolio. I try to mix it up to where it's like, hey, let's learn something different about options. We're going to focus on options, but hey, here's some other things I'm interested in or I'm reading about. So I try to mix it up a little bit just because, fortunately I have a background that I can talk about a few different things. Yeah. Maybe that's why they come back.
I love it. No, I'm giving you a hard time. I want to come back to that. We'll get your takes on the economy and where we're headed here, but, sticking on this retail thread, like what the most retail option traders get wrong? What's the biggest mistake you see them make out there that if you could just grab each of them by the scruff, you'd say, stop doing this?
It's mostly like they get really enamored by high returns. And so we'll do a thing where we'll like, hey, send in some cover call ideas and we'll publish our favorite ones and just like, so you can share with the group and people will send in stuff and inevitably it's going to be like stuff that I would never recommend because it's too risky. And it's like, hey, I can make in 2 weeks, I can make, 8% with a chance of, if it gets called away, I've made 30. I'm like, but you're forgetting the fact that this could also go down 50% over that period.
Yeah.
I'm like, that there's a reason why, we use Ford instead of Nikola for a cover call trade, even though it's not as sexy. Right. And so that's generally the biggest thing, at least with cover calls, is that people, people really get excited when they learn on how to do it, about like making these really, high premium trades. And I think that's fine every once in a while, or, like if you're doing 10 trades and one of them could be that way. Right. But it's just, it ends up being a big part of someone's portfolio. And then as you said, you have that tail event and they give back all their gains, right, in one period. Whereas the stuff that I generally recommend is, we're still significantly outperforming the market this year with our recommendations, even though most stocks are down. Right. So
do you think a lot of the platforms, right, and the proliferation of like, I don't know if Robinhood even has this, but I know E-Trade does. I know some of the others, right, of like, you just click on the tab, income producers or something. I can't remember what it's called, right? But it'll just give you the list. You can move the slider and I want to make more than 50% and be like, cool, here's the options and the stocks that'll allow you to do that. But to your point, it really kind of masks the risks involved.
It's good and bad, right? It's good because, again, like if you can do the research and realize that, hey, these first 5 are not good, but the 6th one actually is a really good idea, and I wouldn't have thought about that had I not seen this, right? But again, like, it needs to come with education. Like I like the no commission, easy access. In theory, I like what Robinhood is doing. The problem is that you don't have the education component, and I think that's really what I try to do. Like, and it's like I love what I do. I also really like helping people. I love when people write me an email that said, hey, because of you, I can retire. Literally, I've had people write in, because of you, I can retire earlier than I planned, and I feel comfortable with it. That is why, 100% why I'm doing it, right? Because as a floor trader, yes, you're doing something.
You're not getting any of those calls.
Yeah. Right. Well, you're providing liquidity. You're doing something useful, right. But whatever.
The pension doesn't send you a letter. Thanks for providing liquidity and
exactly. People think you're the bad guy, and sometimes maybe you are and something. But I mean, it's like it's like the best part of this is really helping people understand and doing better. And so, that part is. So again, Robinhood, I think, helps to some extent, but if you don't have the education component, then you're probably gonna kind of screw it up.
Yeah. But it feels to me, do you feel like we're in the golden age of options trading, right? Of like the amount of tools and info and everything out there to really, if you wanted to, right, you could become PhD level and in a year or something, right? And have all the tools at your fingertips and the knowledge.
It's unbelievable. Like you should have seen like the subscriber growth in my products once basically COVID hit and commissions went away. I mean, it was ridiculous. Now it's obviously slowed because people don't have money to invest.
They're not getting free checks from the government. Yeah.
Yes, exactly. Yeah. And they need to spend, the money to $500 to fill up their gas tank. But I mean, that's, the growth over that period was insane. Like I never thought it would happen the way it did. It was, and again, it was,
and matched by the volume, right? All the volume charts are showing like record option volumes.
Yeah.
Yeah. I got a quick WorldCom story for you. The what was the guy's name? Bernie Ebbert.
Yeah, Ebbers. Yeah.
So I was talking with this. I think he's coach on my kid's baseball team. We were having a beer, and he was he would sell. Right, he was selling whatever they were selling. WorldCom services, telephone services, and Jordan Belfort of the right in New York was his client.
Wall Street. Yeah.
Wolf of Wall Street was was one of the best revenue producers for WorldCom, right? Because they had the boiler room and they're pounding the phones and dialing long distance essentially. So this guy I'm having a beer with would bring his bill into Jordan Belfort, and it was like, right, it was like a couple dictionaries stacked on top of each other. He's like, here's the monthly bill. So he'd say Bernie Evers would come to New York and just grab him out of the office, be like, let's go, and they'd take him out big steak dinners and be like, keep that Wolf of Wall Street account going. That thing's great. So when that was one of the biggest revenues, might have been a red flag of that the company was not long for this world.
Too bad I didn't know that at the time. Right?
I know. Too bad. But it's also hard to believe, like, what you used to charge us for long distance. What? Like, it's no extra unit of work. So let's finish off with kind of your hottest take or some of the stuff you've been thinking of in terms of, you said kind of global macro-ish or central bank-ish, of some of the themes you've been seeing and tying in with some of your stuff.
Yeah, I mean, I'm actually reasonably optimistic that we're not going to have some kind of prolonged recession. The Fed gets a lot of criticism, and some of it is deserved, but I think they've basically done a solid job. They couldn't raise rates too soon because of COVID, and we just didn't know how bad, and if it came back, would it be Delta or would it be Omicron, right? Is it going to be something that, ends up keeping your kid out of school for a week, or is it something that's going to put you in the hospital? And we didn't really know. And so I think they did the best they could, given that,
this is a hot take, right? Nobody on FinTwit's like, Fed's doing pretty good.
I really think that, I mean, I think that, yeah, I mean, maybe they're focusing a little bit too much on gas prices and stuff like that. But I mean, it's, for the most part, like, I mean, it's a tough situation, right? You want employment levels to stay high, particularly post-COVID, right? After everything that happened, you want people to have jobs. On the other hand, you hear everyone complaining about, they're showing their screenshots of their gas prices and their food prices. And the ironic thing is that the Fed has very little control over any of that stuff anyways. I mean, that's really more of a fiscal policy thing rather than a monetary policy thing. But still, I mean, they're still, that they hear the criticism on that stuff. And also gas prices do certainly, oil prices certainly filter over into the core CPI stuff for sure, because everything needs to be shipped, and power and all that other good stuff that we rely on. So, but I think that they're doing a reasonable, I think they're doing a reasonable job. I don't know about like the whole, leaking the article supposedly to the Wall Street Journal and then hiking 75, who knows? I'm not a conspiracy theorist, but, I mean, I felt like maybe the last month or two, the messaging could have been a little bit better, but for the most part, they'll get to whatever it is, 3%. And I think prices will come down, and I think the economy will, unemployment will rise, but I don't think we're due for some kind of, some kind of like major recession, or even, I think it's going to be really, I think it's going to be a relatively soft landing. My only concern really is the supply chain stuff. I mean, is how long is it going to take, and is basically the war, Ukraine, and is that going to drag on for, how long is that going to drag on? Yeah. I mean, so, there's certainly a couple things going on there that can't be controlled, but I mean, I'm never the person in there saying, oh, the Fed should have done this or should have done that. Like, I mean, it's I know that's not a popular take, but
how much does volatility's behavior over the last 3-6 months inform that take, right? Because like, it's basically saying what you're saying, right? Of like, hey, there's not a huge problem here. That's why we're hanging out in the 20s, not the 40s.
Yeah, and then volatility of volatility, like the VVIX or whatever you want to look at, has been really low. Like, it's been pretty stable. Like, people are like, okay, I'm preparing for roughly 2% moves per day, and that's it, right? I'm not preparing for 4% moves today, but I'm also not preparing for 1% moves.
Yeah.
Now, if we keep realizing 16%, eventually that'll drop down. But again, summer months, people on vacation, all that good stuff. So we'll see.
Well, thanks, Jay. It's been fun.
Thanks, Jeff.
Any last thoughts before we go? Tell everyone where to get your stuff. We'll put it in the show notes too, but tell them where to find you. If I said anything that at all interests you, you can check, you can go to Investors Alley, investorsalley.com, is where I am. And, and I'm not the only one there. We have all kinds of great writers and interesting people. So check us out. Beyond that, I hope to not be proven wrong on the Fed stuff and the soft landing. If not, then I'm sure I'll just draw a picture on VIX and blame Ben Eifert for it. So that's right. It'd be like a Godzilla or something, right? Big, tall something in the front. about to fall over. The Godzilla one. I love it. Well, thanks. We'll talk to you soon. Thanks for coming on short notice here. Jay helped us out. We had a dropout this week, so he decided to come on. So round of applause for Jay. And keep doing what you're doing, man. Love it.
Thanks, Jeff.
All right. Thanks so much.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.